Are you looking to make better investment decisions? How to take your game to the next level? Maybe you're a seasoned investor or you're just getting started. In today's podcast of the Fi Guys, we're going to talk to you about how investing in the stock market is more like poker or like chess. Stick around to find out. This is the Fi Guys. Let's get started. All right, Dominic. So on today's video podcast, we're going to be talking about how to make better investment decisions. And in order to do that, I'm going to pose a question to you. Is investing in the stock market more like poker or like chess?
Interesting. I hope the viewer contemplates this themselves as well. Like, don't just take what we're saying and be like, okay, I agree with what Chris is saying. I agree with what Dom is saying. It's like, no. Take a second, formulate your own opinion, and then we're gonna come in and bam, we're gonna give our opinions. That way, it's like it's a 3-person interview, a 3-person idea. Because I want the viewer just to, obviously, I want them to listen, to watch. But I also want you to cognitively think and use your brain. You know, don't just take our ideas, make your own ideas. We want you to think for yourself. That being said, what's your thought on this, Chris? So I can kind of copy it. I'm just kidding.
Yeah.
No. So the question is the stock market more like poker or more like chess?
Yep.
Interesting. I think most people would think it would be more. That's tough. Because I've heard that the stock market is considered like the biggest casino in the world. And I, for one, agree to that to certain extents. You know, there's certain instances where it is just pure gambling. And others where it's like, no, this is what we're doing. We have a sound plan and here's what we're going in with. Interesting. I would say
let's not think about what the general people would say. Let's think about you, Dominic.
Okay.
What do you, Dominic, think? More like chess, more like playing chess, or more like playing poker?
Dude, there's a lot of options you can take when investing in the stock market in particular, which makes me feel like it's more like chess. But chess, there's strategy, there's a calmness to it. It's way more like poker. It has to be. It's way more like poker. It is. I mean, you can have strategy in poker, but at the end of the day, it's still gambling. Like, it's still strategic gambling at best. That's my thought on it. It's got to be gambling. What are you thinking, Chris? You think it's gambling?
Well, let's get into it, and then I will tell you my decision at the end of it, and we'll see if we maybe are able to get you to reconsider your thought and think that maybe it's like chess.
Okay.
So let me go ahead and first break down the two sides and their comparisons. So first off, poker emphasizes elements of risk, uncertainty, and human psychology, right? You need all those 3 things because whenever you're gambling, you're taking on risk, you're taking on uncertainty, but more importantly, you're taking on your opponents. And you're trying to figure out what do they have that I might not have, and then they're also trying to figure out what does he have that I may not have. Versus chess. Chess highlights the importance of strategy, planning, and more importantly, skill. So if you look at the stock market and investing, do we think the stock market is a risky, uncertain place where only psychology wins? Or do we think that investing is strategy, long-term planning, and more importantly, having the good skills to stick with it? So you said that you thought that investing is more like poker than like chess. So let's go ahead and take the point for chess, okay? So
all right.
I'm sorry, you said it's more like poker. So let's go ahead and take the point for poker. So poker has uncertainty and risk. And just like in poker, investing involves managing unknown unknowns, similar to poker, where we're trying to figure out what does the future hold. And since no one knows what the future holds, we have to always have a reasonable degree of certainty or a margin of error for in case things go against us. Just like in poker, the hand may go against us, even if we have a very good hand.
I like that description you were given. I like that. That was solid. I like it. The long-term thinking versus the uncertainty versus the psychology versus the importance of strategy. I love that. That's a great way of thinking about it on a deeper level. I love that. Because we can go surface level, but here at the Fi Guys, we need to go a little bit deeper. We're all about getting deep. Anyway.
So next I want to talk to you about the psychology of bluffing. So both market sentiment and investor behavior can affect the outcome. So just like in poker, when we have hands that are dealt and people are all bluffing or lying, we have to use the psychology of what are these other people going to do. Same with investing. We can't just go ahead and say everyone here is a rational actor, because everyone is dictated by fear and greed, which are emotions. So just like poker, people can get ahead of their skis and try to make bets that they shouldn't be making based off the hand they have. And it's the exact same thing in investing.
Yeah, absolutely. Absolutely. I would agree with that 100%.
And investing is just like poker in that there's a luck factor. We must also consider the role that luck and chance have in short-term market moves.
I think it's interesting how you correlate, like, you have to not just think what you're thinking, but what the opponent is thinking. Because really, when you're investing in the stock market, depending on how you're investing versus if it's like, mutual funds, or if you're just straight stock picking, it's definitely, you definitely have to get into the minds of the average consumer, the average stock picker, the average investor.
Mm-hmm. Yeah, and it's tough, right? Because whenever you think about what is a future stock value worth, it's worth its current cash flows and its current earnings times a story about the future. And you hope that that story about the future is going to be better than it is today. Therefore, meaning that that stock value today will eventually be sold for more. Because while we all want to be long-term buy and hold, we all buy into the stock market because we believe that in 100 years, 10 years, 50 years, 1,000 years, the world will be better then than it is today. More profitable, more whatever you want to look for, that someone will pay a higher value for those future companies than they will today.
Yeah. Yeah,
So
it's all about
I'd
what
like
the
to tell you
next
a
guy
little
will say.
story.
Please.
Yeah, I'd like to tell you a little story about an example about how investing could be like poker. And the story I want to tell you about is the dot-com bubble. So this was 1997 to 2000, really the late 1990s. Saw a frenzy of tech stocks. And many investors started pouring money into the companies with little more than a business plan. Some companies didn't even have a business plan. Their company name just ended in .com. So just like poker, players betting on bluffs, or just like poker and players betting on bluffs, investors chase the hype, leading to a massive bubble. And when that bubble eventually burst, people who quote unquote bet on these companies without solid fundamentals lost big, which highlights the role of both luck and timing in the stock market.
Interesting. So it's just a crowd mentality, basically, is what happened. And people were really throwing like .com at the end of their company name?
Yes.
No kidding.
Pets.com.
Yeah. Yeah.
They had no
Wow.
business model. It was pets.com. It's the same. We see this over and over and over again. Remember when cryptocurrency started to become a really big thing for a little while, and everyone was like blockchain this, blockchain that, and companies would just go ahead and like add
Yeah.
blockchain to the end of their name.
Yeah.
I think it was Snapple. Eventually, like one of their reports put like, "We are Snapple, the lemonade company, powered by blockchain," which doesn't make sense at all. And now you can see the same thing today in AI, where companies that have no business with AI are saying like, we're powered by AI. But historically, of course, companies have been powered by AI. We've been powered by AI since the early 2000s.
Yeah. Yeah. It's silly. It's silly. It's just do you think it's a marketing ploy, or is it just human I don't even, human error isn't even the right word. It's just like a weird ploy to stay relevant from companies who feel like they're being left behind.
I think it's a cognitive bias that we all have, that we latch on to the most recent thing that sounds good. And then if everyone is running in that direction, we all assume that, oh, they must be running in the right direction because they're all running there together. But just like a herd of antelope running towards the edge of a cliff, just because they're all running there, if you could be the one antelope that goes, I think there's something over there that we don't want to go towards, then you could be the one who sets yourself apart.
Yeah,
So let me tell you
absolutely.
another story,
Please.
a more recent story that people might be able to better understand. This is the GameStop short squeeze that happened only in 2021. So retail investors from Reddit, Wall Street Bets subreddit, took on hedge funds by driving up the price of GameStop stock. Remember all this?
Mm-hmm.
So these events had all the hallmarks of a high stakes poker game, where small investors used their collective psychology to force a short squeeze, causing hedge funds to lose billions of dollars.
I like that. I won't deny. That feels good. I won't deny. That puts a smile on my face. Yeah. No, I remember that vividly. I knew people that invested in GameStop. I love it. I love it. I
Yeah.
love the idea of collective people getting together to make a sizable investment to take down an enemy of theirs. I love that story. Does it always end
Yeah,
good?
but
No.
we have to remember that story though, that you're thinking of, oh, all the people that were successful. But for 99% of the people, or for 99 people that were successful, there were thousands that were not successful in that lost money in that short squeeze.
Oh yeah. Of
And
course.
that's not the hedge funds investors. That's the everyday person that came in, started buying on Robinhood. Some people made out big, 2 to 3% made out big, and the rest of the 97% lost a lot of money because they followed the crowd, and the crowd eventually ran off of a cliff.
Yep.
So
That's true.
let's bring in some expert opinions on the matter of, is investing just like poker?
Okay.
I want to talk about Nassim Taleb, who is the author of the book The Black Swan. Now, Taleb often emphasized the role of randomness and unpredictability in markets, akin to luck and chance found in poker. He argues that while skill is important, much of what happens in the market is beyond prediction, very similar to poker. You might have the best hand, you might be the best poker player in the world, but you could still get beat by someone who has no idea what they're doing because they just happen to have a better hand.
So he's talking about that. I mean, that's a great point. That's a great point. A lot of it has to do with luck. A lot of it has to do with luck. Be the most skilled and smartest people in the world, and some of them are the smartest people in the world, but they don't make the greatest investors. Now, how do you think luck plays into, say, like a guy like Warren Buffett, right? He's smart, but he's not a genius. He's patient, but he's not, you know, any other way. Do you think how much of luck played into his life?
I think that a lot of people would be afraid to admit that luck plays a far larger role in most people's lives than you ever do. And by luck, I don't mean that he just got lucky on buying his stocks. He was lucky in that he was born to two parents who were in America. He was
Mm-hmm.
lucky that he had the knowledge that he had, that he met the right people, that he read the right books, that he saw the right magazines in his whole life that led him to be who he is. But where some people might say buying into the stock market is akin to luck, Warren Buffett says, yes, if you're buying on the short term, then it has all to do with luck. But where Warren Buffett has really differentiated himself is that he buys for the long term, and he always buys with a margin of safety, where he's trying to take luck out of the equation to really stick onto his strategy.
Mm-hmm.
Before we move on to talking about chess and where Warren Buffett might say that investing is more like chess, I want to talk one more thing about poker and tell you another example. So I want to talk about Howard Marks, the co-founder of Oaktree Capital. Mark compares investing to poker, saying that understanding the psychology of other market participants is the key to success, much like reading an opponent's face or hand in a poker game.
Spot on. It's spot on. Because that's who you're going up against. It's not even, it's the buyer and the seller of the stock. Are they willing to sell at that price? Are they willing to buy at that price? Are they willing to buy at a much higher price or sell at a much lower price?
Yeah. I
I
think that's something
listen.
people forget. That
Yeah.
people forget that whenever I want to sell my stock, that means that I am buying it from somebody else. And whenever I want to sell my stock, that means that that means whenever I want to sell my stock, that means that someone else needs to buy it from me. It's not just going out into the void. That's the reason that things are a little bit difficult. That's the reason we used to have stockbrokers, where we used to be able to match up a buyer and a seller. But now it's all done digitally online, and it happens in seconds, that we forget that there is somebody else on the other side of that screen. Whenever we press that sell button, there's someone else on the other side of that screen who's pressing that buy button. And whenever we buy something, there's someone else on the other side of that screen who's selling something. And we need to ask ourselves, whenever you buy something, another stock from somebody else, do you really think you're smarter than the other person on the other side of that screen? Do you think that they might know something that you don't know? That's the reason they're selling it.
Mm-hmm. That's true. It's true. It's all a psychological game, which could make the case for chess. could make the case for chess a little bit more.
So if you're finding value, I'd like you to like and subscribe to the video. Please continue to stick around. We're going to continue to keep on putting out videos like this every week. And with that, let's go ahead and talk about segment 2, the case that investing in the stock market is just like chess. So in chess, what are we doing? We're working on strategy and planning. So first, I want to stress the importance of long-term thinking and strategic planning of investing. So when we invest in the stock market, we're not trying to worry about what's going to happen tomorrow, what's going on in bets, what's going on anywhere else. We're thinking long-term, we're thinking strategy, and we're planning out 3, 4, 5 moves ahead. And just like in chess, investing takes skills and analysis. And if we want to invest in individual stocks, we should have a deep understanding of the markets and companies, which would be akin to mastering chess.
Absolutely. Absolutely. Yeah, because in chess, you have to know all the pieces. You have to know all the strategies. You have to know different opening moves, different closing moves. And similar like in investing, what's going to be your first investment? Are you going to play it a little bit safer? Are you going to play it a little bit more risky? And in the end game of chess, it's like, okay, how do you want this to end? Are we going to end up on a yacht? Or are we going to end up flat broke? Are we going to save for retirement? You know, do something steady, 7% every year on average? Or are we going to do something risky? Put our retirement in Bitcoin.
In the
And we know
Doge.
our Doge, yeah, even listen, even more risky. Good Lord. Yeah, that's a very Doge-like thing to say though. Anyway.
And then I also want you to think about whenever we are playing chess, we also have to think about predictability. Whenever we consider how certain aspects of investing are more predictable with the right information, like a well-played chess player will do, they have seen so many games of chess that they know the patterns. They know what move you're probably going to make before you even make it. And they're able to be 2 to 3 steps ahead of you, knowing that if I move this piece here, you'll more than likely move this piece there, allowing me to move this piece over here.
You know, part of me does want the stock market to be the chess in this scenario. But if it were to be chess, it would have to be one big ass board. Because it's not a matter of, I don't know how many pieces there are. It's like 20 on each side. It's not a matter of 40 pieces, right? I mean, it's billions of different things happening every day. You know, a bombing over here sways the stock market over there. The stock market crashes here, so houses are more expensive there. You know, there's so many variables that I could make the case where it's like it's not like either of them. But
I think that's a really good point. And we'll talk about that a little bit later on in the podcast. But before we do, let me go ahead and try to make a case or a story as to why investing might be like chess.
Okay.
So Warren Buffett, we all know Warren Buffett invested in Coca-Cola. So Buffett actually purchased Coca-Cola shares back in 1988. It was a classic example of a chess-like investment move. He analyzed the company's fundamental, he looked at the brand strength, its growth potential, and he made a calculated decision based off that has paid off massively over the years. His investment wasn't about quick gains, but about long-term strategy, just like chess.
He's kind of a grandmaster of investing, if you think about it. The turtle versus the hare. I don't know. I always thought that he looked like a turtle. I don't know why.
I really think that Charlie Munger looked like a turtle.
They look like turtles, man. I don't know what they are. I don't know.
Maybe something about just getting older just makes you more and more turtle-like.
Man, we're gonna be some ugly turtles, man. We're gonna be some ugly turtles. Chris is like, nah, not me. I'll live forever.
I'm gonna die young, son.
You think I can be killed when I cold plunge? Impossible. Impossible. My heart rate, my resting heart rate is so low I can't be killed. What were we even talking about? Sorry. Coca-Cola and it being a chess move for Warren Buffett. Definitely a chess move. Thinking for the long term, not worried about getting rich on the next hand, like in poker. But Warren Buffett is not your average investor. He's thinking way off into the distance. He's looking at the managers who's running it. He's looking at the brand, the future of the brand, the assets under management, the assets they control, you know? how recognizable is it. I think, isn't Coca-Cola one of the most recognizable brands in the world?
It is.
It is. So
In order to make the case for chess, just one more for you. I want you to think about Ray Dalio's all-weather portfolio. I've spoken about Ray Dalio before, but Dalio's approach to investing, particularly his all-weather portfolio, reflects the strategic depth of chess. He has created a portfolio designed to perform well in all economic conditions, showcasing his belief in methodical strategic planning over time, much like chess players do when playing a game against an opponent.
Okay. You throw a little Ray Dalio at me. I see. Okay, a little right hook. I see. A lot of references today. Good lord. No Star Wars references. Kind of disappointing. Save that for Friday.
We'll get there.
We'll get there for sure. We'll get there. Okay. Do you wanna what are your thoughts on that?
Let me try to bring up an expert opinion on the matter. And I'm going to bring up Warren Buffett, the CEO of Berkshire Hathaway. I couldn't think of a better expert opinion to be behind me to say that investing is more like chess than like poker. But Buffett often describes investing as a game of skill and strategy. He stresses the importance of understanding a company, its business model, its competitive advantage, and long-term growth potentials. Much like a chess player carefully considers each move of both himself and his opponent.
You know, I don't remember the name of the book. You've talked about it. But it was like The Way of Seven Deadly Somethings. And it's like once you start to see the patterns in one thing, you start to see the patterns in everything. I'm equating chess and poker and investing to other things like combat sports, jiu-jitsu, training, learning. I hope that the listener can kind of see what I'm talking about, hear what I'm talking about. Because there's a lot of patterns I'm seeing.
I would agree, and I would akin to that old Miyoto Musashi quote. For those of you who don't know, Miyoto Musashi was the greatest swords fighter of feudal day Japan, and his quote was, "The one who knows the way broadly sees it in all things." Which I think I would akin to what you're saying there, Dominic. And yes, as a jiu-jitsu practitioner, I see a lot of parallels between investing and being a business owner, between investing and jiu-jitsu, between jiu-jitsu and being a business owner, between all of these things. They're all seem to work out between just playing a game of chess and and fighting with jiu-jitsu. I want to bring over one more expert opinion to talk about why investing is more like chess than like poker. And this is from Benjamin Graham. Benjamin Graham is actually the father of modern day value investing. He was the one who actually taught Warren Buffett how to invest. If we want to talk about luck, Warren Buffett was so lucky to go to the college where Benjamin Graham happened to work and got to study at the tutelage of him. So Graham's principles in value investing are rooted in the idea that careful analysis and a disciplined strategy are key to long-term success, mirroring the strategic nature of chess.
Yeah. Or you can make the case that it mirrors the unpredictability of poker, because luck would have it that out of all the places in the world to be born, out of all the colleges he went to or could have gone to, he went to this one and met this guy. I mean, it's not like there's a million, fathers of modern investing, of value investing. There's only one.
Yeah. Now, before we get on to the final segment of today's podcast, I'd like our listeners to please leave a comment or review. Let us know, do you think investing is more like chess or more like poker? And with that, I want to talk about segment 3, the hybrid approach. Can investing be both like chess and like poker? Let's talk about how investing might involve both elements of both of them, depending on the situation we happen to find ourselves in. So first up, I want to talk about adaptability. Successful investors often adopt their strategy based on market conditions, blending both risk management with strategic thinking.
Yeah, and from Chris and I's great knowledge, right? We know that only a Sith deals in absolutes, right? You have to be flexible. You have to be flexible to choose.
Ding.
I had to. I don't know if you guys are watching the podcast, go back like 60 seconds and you'll see a smile appear on my face. I was like, oh, I see I feel a reference brewing inside of me. No, but it's true though. To be absolute is not the way forward. It never is with anything in life. You know, to be only plant-based, to be only vegetarian, to be only in the gym and never stretch, to be only left, only right. You know, I don't think as human creatures, we are meant to be absolute on one side or the other. We're meant to be flexible. And to me, the smartest ones are, right? Like you said, the modern day investor, they're going to have some risky hands. They're going to have some safe hands. You know, they're going to think it's like gambling. Oh, are they going to, is the stock going to go up? Is it going to go down? What are we talking? Or is it a value play? Well, I know this brand is known worldwide, great managers, steady income stream, chess move, right? I like the hybrid. It makes the most sense. It makes the most sense.
Yeah. So let's talk about risk management when we're talking about the hybrid approach.
Okay.
The best investors of the modern day, they balance risk, just like poker, with strategy, just like chess. And now I'm going to give you a few examples of how investing might be more of a hybrid approach, where it's a bit of both chess and poker. And in order to do that, I want to tell you a story about George Soros and the British pound. So back in 1992, George Soros decided to short the British pound. And it's a perfect example of blending both poker and chess. He used strategic analysis, much like in chess, to determine that the pound was overvalued, but also took massive risk, just like in poker, in betting against the Bank of England. And of course, that move ended up paying off, earning him over $1 billion back in 1992.
What a keen eye for the details. That's unbelievable.
But I also want you to remember that there's an old quote from the turtle himself, Warren Buffett, that the market can remain irrational longer than you can remain solvent. And the definition of solvent means having assets in excess of your liabilities in order to be able to pay off one's debts. So George Soros could have been very wrong. He may have been right that the British pound was overvalued, but he could have been wrong on the timing. And had he been wrong on the timing, it could have wiped him out, much like had he been playing poker.
So basically, he was all in.
Let's take a modern example, because 1992 is a long time ago. I think we all remember 2008 and the financial the subprime financial crisis. So investors who navigated the 2008 crisis successfully often did so by balancing risk, recognizing that there was a bubble, just like in poker, with strategic positioning, finding undervalued assets post-crash, just like chess. So some people haven't heard about this gentleman, but hopefully you have. John Paulson's bet against the subprime mortgage is a classic example of how this works out. So John was, before 2007, he was just a run-of-the-mill financial advisor / money manager. No one really knew about him. But after 2008, he made over $4 billion and was churned from an obscure money manager to a financial legend by using credit default swaps to effectively bet against the U.S. subprime mortgage lending market, making him a household name.
That's a lot of money. I think everybody does remember the 2008 housing crisis. Wow.
But again, he could have came in there and said, I think it's going to be there. He could have put out all the money against it, but then things could have remained irrational longer than he could have remained solvent. For example, we haven't had a bad recession since COVID. And even when we did have our COVID recession, it was only for a little while, a stock market crash of more than 30%. It happened and then immediately reversed course. There are many people right now who have been stating for the past 6, 8, 10 years that we are in a bubble. And if you have been shorting the market, thinking that that bubble is going to come for the last 6, 8, 10 years, the market has remained irrational longer than many people have been able to remain solvent. And the most dangerous words in investing are, it's different this time. Those are the famous last words of all investors.
Absolutely. And it's not a matter of like, if the market will crash. We know it'll crash. 'Tis the cycle of life, We know more kids are going to be born. We know more people are going to die. 'Tis the cycle of life. Are they going to be born today? Are we going to die tomorrow? I don't know. Is the market going to crash tomorrow? I don't know. I don't know. Is it going to crash in 10 years? Maybe. It's the arrogance of man to assume that they know everything, but really,
Yeah, I think it's so difficult, right? Maybe you
yeah.
can't say, is the stock market going to crash today or tomorrow? I don't know. But may it or will it likely crash in the next 10 years? Probably.
Yeah.
More than likely, yes. But I can't choose what day that's going to be.
If so, we'd be very rich. Also, we'd probably be witches, so they'd probably burn us at the stake. But or financial legends, it could go both ways. We don't know. Yeah, it's foolish to think that a person could know more than the market. If you're going to take anything from this and you're a new investor, you don't know more than the market, and you don't know what it's going to do tomorrow. That's pretty much it.
I would agree. And I'm going to bring in an expert opinion on this again in order to say that investing is both like poker and like chess, and that maybe the best thing you can do is be cautious if you don't know what you're doing. And the person I want to cite is Charlie Munger. Charlie Munger was the vice chairman of Berkshire Hathaway. And Munger advocated for multidisciplinary approach when investing, combining both strategic thinking, much like chess, and realistic understanding of human behaviors and market psychology, just like poker, if you want to be a good investor in the modern year.
Dude, I keep swaying back and forth between chess and poker. I wonder what the viewers thinking.
Me too. And I'd hope that they're going to leave inside the comment.
Yeah. Please leave a comment. Leave a comment, like the video, all that fun stuff. If you are watching on YouTube, we do appreciate a like. If you are watching on Spotify, Apple Music, wherever podcasts are listened to from you guys, make sure to give it a like or a follow if you're not already following. We would really appreciate that.
And I'll give you one other expert opinion from Peter Lynch, who is the former manager of the Magnolia Fund and author of One Up on Wall Street. Lynch is known for his approach of investing in what you know, which involves strategic analysis, just like chess, but also being willing to take risk when the odds are in your favor, just like poker. So I want to recap some of the key takeaways that we have here today. Number one, is investing in the stock market more like poker or like chess? In poker, we have to emphasize the elements of risk, uncertainty, and psychology. Where in chess, we have to highlight the importance of strategy, planning, and skills. So Dominic, I'm going to pose the question to you again.
Mm-hmm.
Is investing in the stock market more like poker or more like chess?
Depends on the investor.
Just the investor?
Well, I would say that Warren Buffett is not much of a gambler. I would say Bill Ackman is probably a little bit more of a gambler.
I would agree.
I think even if you are playing chess and you see investing as chess, there's still risk with every move. Depends though. Are you risking your queen or are you risking a pawn? Are you putting it all in or are you just, a portion of your bank, right? I think it can be chess for some and it can be poker for others. But to say it's one or the other would be a mistake in my eyes because it's both. It can be both. You can put all your money on one stock. I know people like that. You can put all your money in a mutual fund. I know people like that. Poker versus chess, right? Is either way going to make more money? One might make more. One might lose more. It's just the game. It's the game we're playing. What are your thoughts?
I would take it a step further. It's not just doesn't have to do just with the investor if it's poker or chess, but also on the conditions. The way the world is at the moment also makes it like poker or like chess. And I want to take this in a different direction, much like how we talked about earlier, where one who knows the way broadly sees it in all things. I want to talk a little bit about physics. So in physics, if I was to ask you, what is a light particle? What is light? Is it a particle or a wave? What would you say?
I thought it was a photon. I don't know.
Yeah. What is a photon? What is a photon? Is it a light or a wave?
I don't know. That's above my pay grade. I have no idea. I have no idea, Chris.
Okay. So we all thought, or for a long time, people thought that photons of light were acted like a particle. But then when you actually throw them through a double slit experiment, you see that they act like waves. So everyone said, okay, then light must be like waves. But then we moved our advancements in science and we were able to actually begin to study the shot of a single photon. And once we were able to observe that single photon pass through a slit, on the other side of that slit, now that photon interacted as a particle. So light is both a particle and a wave, which is very, very strange. But just like investing is just like poker and just like chess. And our human brains can only conceive of things that we can have something that we can compare it to. I like to think, or people like to think of light as a wave because we know how waves interact. We can see that. Or they think of it as a particle because we can see how particles interact. But maybe there's a new way, a different way of viewing the world that we can't conceive of. And that's actually what light is. Just like investing. Maybe investing isn't just like poker or just like chess. Maybe it's neither one of those things and both of those things at the same time. Or maybe it's another thing entirely that we cannot conceive of. Maybe it doesn't have a perfect analogy in the real world.
Maybe it doesn't. Maybe it doesn't. But I like this exercise in thinking and thought and using our brain for once, because I know a lot of people aren't using their brains anymore. It's good to be using your brain.
I would agree. And for this week, our action step is to evaluate your investment approach to our listeners. I would encourage our listeners to take a moment to reflect on your current investment strategy. Consider whether you're approaching investing more like poker, where you're focusing on the risk and the psychology, or more like chess, where you're focusing on the strategy and the analysis. I would also suggest that you write down your thoughts and identify one area where you might want to improve or adjust your approach. This can be doing more research on a specific investment strategy, learning more about money or market psychology, or even diversifying your portfolio. And again, I would ask you to go to the comments and tell me, do you think that investing is more like chess, like poker? Maybe it's like both, or maybe it's like neither. I'd love to hear differing opinions because in actuality, I don't know. My thought is it's like both and it's not like both simultaneously. Just like Schrodinger's cat. The cat is both alive and dead until we open the box and find out.
It's true. It's very true. I like that.
Before we close out this podcast, I want to talk about one other thing. And, is the future deterministic or chaotic? In predicting the future, if we knew every single thing that was going to happen, the position of every molecule, every atom, could we 100% predict the future? Or is there so much chaos in that there's nothing we could do to ever predict it? If we had a computer the size of the universe that could take on every single piece of matter, could we predict the future with 100% certainty? Of course, this is a theoretical discussion, but when people sit there and they pontificate about what the stock market's going to do, all they do is they sit there and they speak it with certainty. But in truth, they have no idea because no one, and I mean no one, knows every single thing that is going to happen and has happened in all of history in order to see what's going to happen next.
With that being said, very interesting podcast. Hope you guys enjoyed that. Hope you guys came up with your own idea on is the stock market is gambling like the stock market? Is the stock market more like poker or is it more like chess? Or is it a bit of both? Chris, any final thoughts on that?
No, I would say if you're stuck around this far, please like, subscribe, and tune in next week and for Five Friday feedback. But I would hope that if you got value today, that you'd be able to help Dominic and I in order to spread the word of financial independence, because we're really trying to grow our audience as much as we can. So please tell a friend, tell a family member, tell the person who you're next to sitting on the bench, hey, have you heard about the Fi Guys? Let them know. Spread the fire of financial independence. Let everyone know, because it's so much more fun to go on this journey with a friend than to go alone.
Absolutely. That being said, hope you guys have a great week. We'll see you on Friday. Later, guys.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.